Welcome to Stock Cheat Sheets, where we trend, rank, and grade stocks and exchange traded funds. Our data helps forecast which parts of the market are about to get hot and which equities are likely to blow up in your face. You can subscribe and get cheat sheets delivered to your inbox. Best of all, it's free. Go to stockcheatsheets.substack.com to learn more.
Now, here's today's free update.
Hello. I am Mike O'Connor along with AA, and we are the Cheat Sheets guys. This is a free service that you can get at stockcheatsheets.substack.com. We take a look at the market, and we provide trading signals and relative strength, rank, and trend reports on pretty much ETFs, covering the full spectrum of the world geography, different market caps, and different industries. We also deal with commodity-based ETFs and currency-based ETFs. And what else? AA, fixed income, which is your specialty. So although we're not going to do any of that today, but we're pretty much all over the place. So the market, zigging and zagging, what to make of it? Which direction are you pulled in? The Fed, I'm fighting inflation, I'm going to keep rates going, or are you in the what the hell? The banking system may be collapsing. Stop.
I don't really have a strong opinion either way, but if you made me choose, I'd probably say let's keep after this inflation thing. That would be the side of that fence I'd come down on personally.
And so you and I are just slightly in disagreement because I'm tepid as you are about picking a side, because I don't think there's any good choices, and that's the bottom line here, right?
Right.
So we eased like we've never eased before through the pandemic, and we kept that funny money printer on for way too long, and we got inflation up to nearly 8%. And now it's down to only 6%. So that took 4.5 or 45 basis points. No, 450 basis
450.
Points, right?
Yeah.
You had to go from 0 to 4.5. So we did a quarter point last month, then something blew up. What are we up to? How many banks are in crisis now? I think it's like 3 in the U.S. and then Credit Suisse, right, over in Europe.
3 in the U.S., Credit Suisse, and I did see a note late Friday that economists, and I don't know who economists are or how creditworthy this is, but economists have identified more than 100 other banks in a similar position with basically insolvency if their assets are marked to market.
And so, listen, you know more about fixed income than I do as a mortgage trader. You look at that market all the time. But do I have this right, that essentially these institutions, because rates were so suppressed, they had the depositor money and they basically just went up the risk curve looking for some type of yield to make the spread between the money they're bringing in on their investments and what they're lending out at rock bottom, rates. And then, Dodd-Frank, I think, got repealed in some way that allowed regional banks to really roll the dice. Do I have that about right?
About right. Yeah. The Dodd-Frank rollback just lowered the threshold for which they were subject to rigorous testing. Yeah. And I think in the case of SVB, at least from what's known and what I know, the real problem isn't really, it is the interest rate risk and the duration risk, but also it was unhedged, which is just insanely poor management.
Got it. So they just basically threw caution to the wind, saying, hey, listen, we've got 2 standard deviations worth of wiggle room here. That thing is not going to, it's only 5% chance, right? What are the chances? Right. Probably youngsters that got into a position of power too quickly and probably weren't even born in 2008, for God's sake.
Well, I'm sure you don't want to talk about this too much longer, but I'll wrap this up with this little tidbit: is that the CEO of SVB also sits on the San Francisco Federal Reserve Board.
Oh my goodness! Okay, he's not the president though. He's not a voting member, is he?
No, but he's a member of the San Francisco Federal Reserve Board. Yep.
Yeah, it's all so incestuous there, right? Regulators, the regulated become the regulators, and the beat goes on. The American kleptocracy experiment continues. But all right, so it's about a 40-60 chance. 4 in 10 traders think the Fed, like me, thinks something broke. Let's wait 6 weeks, see what we need to do, and then we'll start hiking again, because they definitely don't have inflation under control. I think we talked about that a little bit, that the CPI was, it was flat, right? and inflation just didn't go up as fast as it had the month before, right? By maybe 0.2 of a percentage point, if memory serves me.
Yeah. It was flat. I think flat's a really accurate description for the last CPI. Mm-hmm.
And then the PPI, which the market doesn't really pay attention to, but I do since it's a leading indicator, that one definitely is suggesting downward momentum. It looks like producer prices, they didn't go down, but they accelerated less, if memory serves.
Yeah. I mean, my fear with the Fed this week is that if they do pause, they're done for the cycle. And at that point, inflation becomes a real sticky problem, I would.
Okay. Yep. So you're thinking that even though it is inconvenient, that if the Fed were to pause now, they're never going to find a justification because this bank crisis is probably here to stay. Is that kind of the idea?
It'll be jump this crisis to the next crisis,
right,
the next crisis, and they'll never have the ability to keep going if they stop.
Were you surprised as I was? We're going to talk about Europe in a minute, but let me save that. But the ECB's raise on 50 basis point raise on Thursday is probably the tell that the Fed is going to raise 25 basis points. So as far as economic calendar goes, we've got one that's in your wheelhouse as a trader. They're still expecting, that Fed watches this one, right? Existing home sales expected to rise a little bit. And of course, the Fed would like to crush the housing market. So that's still going up. But new home sales, which is a later on metric, I think that's, do I have that here? I think that's later in the week.
Yeah, you have it on Thursday.
Thursday, right. And that I think is expected to come down a little bit from month over month. Yeah, about 21,000.
Mm-hmm. Okay.
So home sales is a wash. And then we've got the rate decision on Wednesday and the cringe-inducing press conference that will probably send the market down because that's what Jerome likes to do. And then we have claims, which are expected to grow a little bit. And I guess in a perverted good news is, or bad news is good news, the market applauds unemployment right now.
Yeah.
Especially if it comes with wages being flat to down.
Right.
All right. And then finally, durable goods. Now that one really is mostly about where we're at in terms of the factory output. And the U.S. is still expanding. We're above 50. So that's expansionary, but looks like month over month, we're going to dip just a little bit from 50.6 to 50.3. And though I can't see it because my slide advancing knob is here, I believe that rest of world is contributing to overall contraction. We're under 50. And I think the move is 47.3 to whatever can you see the number to the left of 47.3?
Yeah, the median forecast is 47.0.
Yeah, okay. I just can't see it because of the little admin tool in my way. But so there you go. A little contraction from the rest of the world, a little growth from the U.S. Who knows, right?
Right.
So that all leads to the market. And, just very quickly, before we get into it, 21 seconds of your time, you can hit the fast forward button if you're watching this and familiar with it. I just want to explain the tailwind score and the 10-factor check.
The tailwind percentage is a composite rating of each index, the result of 10 key factors related to current trend, relative strength, and momentum. The higher the tailwind score, the greater the number of bullish factors influencing these stock indexes. A tailwind score of 50% is mildly bullish, and a score over 60% is optimal.
So basically, that's a composite of these 10 factors here. And these 10 factors are not proprietary. This is all regular, normal, everyday stuff. The first three factors 1 through 3 are nothing more than moving average trends. When you see a red light, it means the shorter moving average is below the longer term moving average. And when you see green, it just means the posture is bullish because the shorter moving average is above the longer moving average. We like to use 10-40 moving average pairs for our stuff here. Buying pressure, number 4, is Chaikin money flow. So anything above 0.1 is bullish. Anything above 0.05 is neutral plus or mildly bullish. And we look at money flow and consider that a fairly serious one. It can oftentimes confirm whether or not I get into a trade. And then relative strength, we're using the IWB, I think it is, the Russell 3000 index, IWB, right?
Okay.
Yep. And so we compare every stock to that. And by doing so, we are then comparing every stock to every other stock. And then I classify them into quintiles. So very bullish means you're way outperforming the U.S. broad market. Very bearish means you're way underperforming that. And then this kind of will tell you we don't really have a relative strength comparison here, but you're classified into a bucket based on the level of outperformance or underperformance you have. So obviously very bullish means you're rocking compared to the market, or if the market's going down less, you can still get a very bullish rating if by comparison you're going down less and you're in the upper quintile of stocks going down less. So think of this as grading on a curve. And we have the 6-month relative strength and the 3. It's always way better when you're outperforming in both. And then we get into something that would take an hour to explain. And so I direct you to the Cheat Sheets YouTube channel, or any one of a number of blog posts where I include a link to the video explaining the market forecast oscillator. To put it in a nutshell, it is the first derivative of the price curve. So if price is velocity, point A to point B, how much price is growing or contracting, this is the first derivative that tells you how fast that contraction or that acceleration is going. And we have factors 7 and 8 are the, sorry, I'm just going to get rid of this annoying phone call. I couldn't have picked a worse ringer. So factors 7 and 8 are what we call senior timeframes. They're predicting through extrapolating momentum, essentially, whether or not something is likely to go higher in the long term. And then factors 9 and 10 are what I call junior timeframes. We use those to confirm a lot of signals when they are kind of, these are all oscillators that are on a 0 to 100 score. And when the closer you are to 100, the more bullish you are. The closer you are to 0, the more bearish you are. When you see those junior timeframes really pegging near 100, that's the time to get excited about a market reversal. So when we see factor 10 mostly yellow, it's telling us that at least disaster is not likely looming on Monday, although that can change with any kind of news. Technical analysis never looks forward, only backward. And then and so the final point is that the short-term oscillators will eventually impact the long-term oscillators, which then will impact price or be reflective in price. So there's lots of different cheat sheet combinations that we use for our trading signals, and we'll kind of cover those today as we go. Anything you want to add to that? I think that kind of covers it.
Yeah, I think that was a really good explanation.
You could go an hour.
Right.
All right. And then relative strength. This is sort of like, think of it like a sports league where, any team can have a good 10-day period, right? And win most of their games. But it's really hard to put that kind of win streak back to back to back to back. And the more stock does that, where it's winning more days than it's losing, it's generally outperforming. And so this measures relative strength against, again, the IWV, but we're not looking at the magnitude of performance or underperformance. We're simply looking at each of these snapshots as an individual moment of time, comparing price then to price now. And that percentage difference then gets stack ranked accordingly. So we put stuff in order based on how much more it's overperforming other stocks or underperforming other stocks. So what you're seeing right now is all of this stuff ranked in descending order based on a 10-day look back period, which is a really small look back period. You can't use that to make investing decisions unless you're a day trader. But what we can do is rank different time frames and keep going out in time, like the last 20 days, the last 30 days, the last 50 days, the last 100 days. And each of those discrete look back windows, we can do a separate rank of price performance, comparing how that time period to today. And then we can rank things in order. And then by showing the ranks, starting on the right-hand side where that's reflective of the current rank, but then as we look to the left, we can kind of see trends unfold. We can see what's growing in rank over time, from longer look-back periods to more recent ones. And we can also see the reverse. And the reason this is important is because many times very micro type price differences show up as institutions start sneaking into or out of positions. Double A, maybe you can explain this, that institutions just don't make one trade, right? They build a position.
Several trades over time to establish their desired position in equities, right?
Yep. And a lot of the trading desks aren't just picking one stock. They're picking what's working, what sector or subsector is in favor, right? And then they diversify and throw their investment across, a number of different stocks that they think will do better than the index.
Right.
And so the institutions are the market, and what we're doing is we're little minnows chasing them. So the bottom line here is that you can build your watch list off relative strength reports, and so you want to pick things that are rotating into favor. And we recommend using that calendar 3 to 6 month look back period, or 60 to 120 days. We mark it up as what we call the sweet spot. 60 to 100 trading days, not including weekends, is 3 to 6 calendar months, give or take. There's holidays, there's 4-day weeks, there's, it doesn't work out perfectly, but in general, directionally, we're right. And so when you see a gradual transition from red to green, and that green rank starts happening in the sweet spot, you next look at the money flow column. I know I kind of explained it lightly, but maybe get into money flow a little bit for everybody.
Money. Oh, it's basically just what it sounds. It's large money flowing in or out of, in this case, ETFs, specific ETFs.
Buying pressure.
Yeah.
We call it buying pressure and money flow. We use those interchangeably, but basically a number above 0.1 is institutions are really rocking. They're picking up shares.
Yeah.
And above 0.2, it's FOMO, panic buying. So when you get above a 0.2, on cheat sheets, we'll either give you the number or call that very bullish. But anything above 0.1 is worth noticing. What do you notice here, though, Double A? Basically,
I've noticed nothing's a 0.1.
Yeah, the exception of Eurozone, and this is a 21-day look back period, so it's a lagging indicator.
Yeah,
and you can see the Eurozone has fallen out of bed here just a little bit, and the ECB probably has something to do with that. We'll get to that in a second. So it looks like it's really tech, large cap tech. I know that there's a lot of talking heads that talk about the impending tech wreck. Boy, I'll tell you what, tech has been leading the market since the financial crisis, give or take. And it seems like our economy has become a tech economy. I'm just not sure that, now listen, a few more banks collapse, everything's going to go down, right? But tech on a relative basis just is holding up the market here.
Can provide my point of view on that, and it's that I think it's just correlated interest rates, basically. So since the financial crisis, interest rates have been held, some would say artificially low.
That's right.
And to benefit to R&D of tech, there's that whole story that I'm sure everybody knows. But
so lots of money going into investment.
Lots of money going in, a lot of cheap money going in, chasing high returns because innovation produces higher returns, right?
Yep.
For every 5 that lose, the one that wins makes up for those 5 plus some. So
5 more, yeah.
I mean, that's my argument with tech, is that I think it's fueled by cheap money, and if in fact, higher for longer comes to be, which still remains to be seen. I mean, has that been priced in? I don't know.
Yeah, obviously, the more interest rates go up, the harder it is for tech because of what you just mentioned. Plus, let's face it, this is also a CapEx related business, particularly if you're Microsoft or IBM that still have enterprise level equipment that goes into businesses, not just cloud-based services. And CapEx can be affected by high interest rates. Companies don't spend as much. So,
just real quick, point out one other thing that causes me just a little bit of caution is that historically, coming out of a bear market, the leaders of the last bull market aren't the leaders of the new bull market.
That's right.
So it just a cause for a little caution for me.
Well, I don't think there's any evidence that suggests there's FOMO going on here. It's just suggesting to me that tech is institutions are not necessarily dumping tech. They're just not buying any more of it. And it's going down less than the market. It's not about it necessarily going up.
That's fair. I agree with you on there.
Yeah.
On that.
Meanwhile, tech is the only intermediate trend, the middle trend, that has a bullish posture. Everything else is negative. That tells you everything you need to know. This is basically, stocks around the globe, and we've now covered them, I'd say, pretty aggressively. Here is the Eurozone. I actually put this chart in a couple of times, but Eurozone, I think, was essentially outperforming because the European Central Bank sort of had some handcuffs, or so I thought, right? Because interest rate raises, I think the Bank of England was sort of the example a few months ago. Remember that when they were, happy to go along with the U.S. Fed and started raising rates, and then something broke over there, and they had to immediately reverse course. You remember that? This was like, I think, January.
Yeah.
And we thought the ECB would be,
I do remember that.
Yes, in a similar position where, yes, inflation in Europe. You think we got it bad here? You know what inflation is over there? The latest print?
It's double digit still, isn't it?
Well, it's not quite that, but now recent months maybe, but the year over year inflation number is 8.5%, which is nearly double digits. So that probably means double digits here in more recent, isolated months. But that's bad. And so there's another central bank facing the least worst choice. It's why I think your prediction is probably right, even though my sentiment is Fed don't raise. If something's broken, let's get our arms around it first. Fewer variables, but they're not going to do that because the ECB rate hiked despite that inflation, or because of that inflation.
Because of it, yeah.
They hiked 50 basis points on Thursday. Now, notice the candle there. I think that Thursday candle doesn't reflect the ECB. I think they announced it at the close. I'm not sure though. Do you happen to know when the announcement happened?
I don't remember.
Yeah, I don't either. It was Thursday at some point, but obviously Friday's candle didn't crash. In fact, you got what's called a harami, which, if anything, is a reversal candle at support, if you can call that gap over to the left support. It's probably kind of a poor excuse for support. Or we have an island reversal, which I see two gaps on either side, and that could be resistance. We'll have to see if we're just going to go down here from here, or there's a reversal. But the harami, which is an inside day, that's where the candle on Friday is inside the body of the previous day's candle. That would suggest the next move is higher. Doesn't mean the trend is going to change. It just means we might get up to 43 before we fail. But it looks like the trend's busted.
That it does.
And down we go. Money flow is stubborn, though. It's hanging in there.
Mm-hmm.
And here in the U.S., I think this is interesting because you and I have learned this lesson over and over again. And I learned it recently with a micro future on the Russell that I traded right about where you see that high there, where I thought there was a breakout going on.
Yeah. And
I stopped out a few days later because there we reversed. And what happens whenever there's a failed breakout?
It's a fast ride the other way.
It really is. Look at the volume on that move there.
Yeah. And also remember the IWM has a lot of these regional banks, right?
Yep. Financial sector heavy, economically sensitive businesses.
Mm-hmm.
And so the Russell, I think that support level at around 170-ish is probably in a little bit of trouble.
Yeah, I agree.
We'll see. Market forecast wise, again, just to reinforce cheat sheets, market forecast would show on cheat sheets the intermediate line factor 8 as neutral minus. It was bullish because it was above 50 and pointed upwards. It reversed thanks to this, of course, we're looking at IWM, not SPY, but this reversed recently and is pointed lower, but it's still above 50. So for now, it's in the upper reverse. It's in the upper quadrant, upper half, I should say, but pointed lower. So neutral minus. If it crosses below 50, it'll go to bearish. And the leading indicators, the two junior time frames, blue the near-term line, red the momentum line, and those numbers are both below certainly 20 for the blue line and below 5 for the red line. That is bearish confirmation. It's confirming the trend reversal of the market forecast and portending that we're going to go lower on the Russell.
Yeah.
One other thing, the market sentiment line has been bearish for a while. This is the long term. This is the months to a year, 9 months on average. That looks like it's pointed flat to up. It's still above 20, so it's not horrible. If it's pointed up, we're neutral plus. If it's pointed lower, which is hard to tell here, we're very bearish. But either way, we're deep in our own end, so to speak, and very vulnerable to having multiple oscillators all pointing lower or getting into the lower reversal zone, which is very bearish and usually portends big ass technical breaks.
Yeah.
So not optimistic for the Russell. And here's the Eurozone again that I didn't mean to put in there. Now, this would be essentially the same exercise, but now we're looking at diversified global assets. We've got some commodities in here, precious metals, some agricultural ETFs. You're not seeing everything, only what's ranked above, what I could fit on page one, but there's, I think, 3 pages of this, and maybe I have it or not. But I think the big story here is that gold is starting to look interesting, even though the trend isn't great yet. The numbers, and it's been, gold has been sneakily, persistently owning some pretty decent tailwind numbers, relative strength numbers. It was neutral plusy for a while. Now it's bullish. Trends are bullish. Buying pressure looks good. The relative strength looks excellent, particularly over the longer haul. And you have some bullish market forecast indicators. Only the long-term forecast oscillator isn't there yet on gold. I'm not in any gold yet, but I did find a gold trade, which I think we mentioned. And if you go to cheat sheets, was it yesterday's? When did I do the gold?
I think it was yesterday. I saw your note on it this morning, so it must have been yesterday.
Now that I think is a premium subscriber note, but you can go grab a 7-day free trial at stockcheatsheets.substack.com, and that way you can look at it. Basically, I walk through the gold ETF, going up, gold miners, looking better. Again, nothing's trending yet, but then there's this one company, which we're going to look at in a minute, where I walk people through a derivatives trade called a naked put. I think it was. Is that what I did with gold with DRD?
I think so. Yeah.
Yep. So pretty good exercise if you're not used to options. I give you a little mini education, but then a link to the Investopedia article so you can get more. But it's a way to wait for a pullback, because that's what gold needs right now. Gold has been kind of pressing its version of the upper reversal zone on the chart anyway, and probably is due a pullback. And me personally, I'm going to wait for a buy the dip to get into anything gold related, but I'm just going to start to nibble here.
Gold probably, obviously benefiting from the fear in the marketplace, right? Around
Armageddon. It's basically an inflation trade, but it hasn't been there for the inflation trade this year. I guess crypto has been the new inflation trade, but it is there for fear and panic and loathing, right?
Yeah.
And treasuries is the other one with a signal. You'll see it in a minute here, but it's I'm skeptical about that. All right, and this is just more of that. So the All Country World Index, this is basically the midpoint here, and that just shows you how awful we are. But between currencies, energy in particular is what I wanted to point out here. There's the DBO, that's an oil ETF, DBA, agriculture. So there's just not that much stuff in the way of assets that's bullish right now.
Yeah.
Other than tech. And this is that same list now, relative strength, just showing you the gold rotating into favor with a good money flow score. So that's about it. And we don't have an intermediate trend yet on it. So,
and just real quick to point it out, since you mentioned it earlier, look at the trend on gold right to left. Like the relative strength trend is clearly established.
Persistent. Yep.
Yeah.
But not yet the physical trend, which always follows, right? This is what we call sneaking in or out.
Yeah.
And why AA and I think this chart, this is not a chart you're going to trade off of, but this is a chart you're going to build your watch list on. Yeah. Now, you're going to notice the watch list candidate list is empty. This is an automated feature. I'll give you the criteria. Gold just doesn't make it because I think it's because of the lack of an intermediate trend here. But in general, to get on the watch list, you have to be a minimum average the top 50% of whatever you're competing against. Every list is going to be different. So it's a percentage rank and not a physical numerical rank, but you have to average in the top half here and have money flow score above 0.1 and have at least one of two trends, either the long-term trend or meaning the intermediate trend or the long-term trend, bullish. So this one didn't light up. I may check my coding just to make sure there's nothing wrong here, because this one looks like it should be a watch list candidate, but it's the only one. Now, if you want to get to be a very bullish watch list candidate, take the money flow and make it 0.2 or higher. And in addition to the top 50% in the sweet spot, you're in the top 33% from the this look back period, which I guess you can't see my cursor, right?
Right. Right.
Yeah. Okay. So the basically the far right of the sweet spot to the far right of the chart, if that's in the top, averages in the top third, then you get a very bullish watch list entry. And we have an explanation for it down here. Okay. So moving on. There's that Eurozone again. I don't know what happened. All my charts got replaced by that one. And so this final collection is our U.S. sector and subsector. And again, just a demonstration that yes, aerospace and defense and semiconductors are basically the only U.S. subsectors that have tailwind scores. But again, the intermediate trend is fully on bearish, and you've got some problems in the swing trading zone where those oscillators are below 20, kind of pinning this bearish. These are not bullish indicators at all. So this is kind of stay awayville right now, and that's what we can say about that. And I think you're just going to see. What's interesting is the more defensive the area we look at, the worse it is. Look at XLRE, real estate, not doing good. Healthcare services, REITs, regional banks, healthcare equipment, financials, banks, IWM. That's the stuff that for those of you who like to sell call spreads or buy puts, which are probably a little inflated right now, or are you doing any put diagonals, AA?
I'm doing some ratios.
Okay, that's right. You like the 2 calls to 1 put, right?
Yeah, I like to do a little ratio.
Yeah, there you go. So he sells calls to pay for his long put. And you're probably licking your bearish chops a little bit.
I'm yes, and even more so now having seen your presentation.
Yeah, it's funny. You spend a little time with this data and you immediately have a burned in snapshot. I feel like I could go on CNBC and compete with any of the experts with an understanding of the market knowledge, and that's what we're hoping to share with everybody here.
Yeah,
because most of these big macro charts are part of the free subscription. Then if you want to go down the rabbit hole, we give you a little more info, like the cheat sheets, extended entry signals that just do a little bit better job explaining what you're up against. And also it's my way of sharing with you what I consider to be, of those 10 factors, the most important ones that should kind of focus bullishly before you consider taking a trade. And I would point out here that this confirmation category is really will oftentimes portend follow through. And there's basically 2 types of confirmation that will come out of here. There is near-term confirmation, that's the blue line, and then there's momentum confirmation. So when you get both, meaning the blue line is above 80 and the red line is above 90, or that's bullish, or 95, very bullish, that kind of close is what will then turn the oscillators that are in the longer time frames around eventually, or it'll confirm a signal, any kind of bullish signal. And the one here that I'd just like to focus on is this bullish trend progression signal and why it's a standard entry. And I think I did do a NASDAQ chart. I'm going to go over here and just hope I did. I did. All right. So I'm a little bit more bullish than AA is here, but I'm not trustworthy that this is by any means a months to years trade. I'm looking at it as a 21-day special, and I think it needs a pullback to buy the dip before I'm going to get involved. But the reason I like it is for the following reasons. First, we broke through a diagonal intermediate term resistance here. Broke through on decent volume, and then, of course, kind of flatlined on Friday. And AA, wouldn't your expectation be, whether it's a failed breakout or not, that it's more likely going to throw back and retest that diagonal downtrending line?
Absolutely.
Yep. So you're probably waiting for a break below it to short it. I'm waiting for a bounce off of that to potentially go long.
Right. Yep.
All right. So the second reason I'm bullish is that green line. So that is the intermediate line that has been oscillating lower. Notice it sort of broke through its own diagonal resistance. If you were to draw an imaginary line from peak to bottom, there's, you can see how the green line sort of cut through that diagonal line. Well, it's oscillated above 50. And this is the most optimal trend progression signal of the 3. Now, remember, the intermediate trend progression signal is all about the intermediate line when it crosses from below 20 to above 20, or on cheat sheets when it goes from very bearish to neutral plus, meaning it goes from that lower reversal zone below 20 to pointed higher and above 20, but still below 50. This is the metaphor I've used a million times. It's like recovering a fumble, but on your own 2-yard line, where you have a lot of room to go to get a touchdown, and you need weapons open downfield. So that is a high failure rate, but huge reward to risk opportunity when you take that intermediate trend progression signal, number one. And the reason I advocate the intermediate trend progression signal being one that you divide into 3 tranches is because the trend has to earn its way higher, and it has to earn your risk. So what you would do in the case of a stage 1 intermediate trend progression signal, again, that green line moving from below 20 to above 20, is you'd only put a third of your capital to work. Because the failure rate is high, and there's probably a better chance than not, it's probably under 50-50 that your trade will work out, and that you'll likely lose your investment. Position size and risk management is incredibly important, and it's why you only give a third of your capital. Now, if the line were to earn another third of your capital, it would cross back above 50. Here, we never actually made it down to below 20, so we just went right to stage 2. But when that green line is above 50, it's sort of like the RSI above 50. It is a sign that we're bullish and that the chances for follow through are better. Now, in order for the trend progression signal to be valid, not only does the green line have to cross above 50, but the blue line has to finish up above 80 in its bullish zone. That's called a standard trigger. The third requirement is that the momentum line can't be bearish. It can't go below 5, and I won't even take a trade if the momentum line is below 10. So those are the 3 things for a standard trigger. And of the 3 trend progression signals, the one that goes through 20, the one that goes through 50, and the one that goes through 80, the one I like the best for a standalone trade is the 50, because it's the optimal, better win rate, still a lot of room for reward, still not necessarily closer to the end of the trend than the beginning. By the time you get up above 80, you're very bullish, but the trend could reverse at any point on you, and I don't think you can make as much money. So for me, the combination of potential win rate and the reward to risk ratio is best with an intermediate trend progression signal above 50. And once again, it requires green line transitions above 50 on cheat sheets, neutral plus to bullish. Blue line transitions from neutral 10 to 90, 80 to above 20 to 80 to above 80. Okay. That's a confirmation signal. And then the red line just can't be in the very bearish danger zone. That's above 5 if you've got the oscillator on your chart. And so the breakout is confirmed with the oscillators, and I am bullish, but I would be either selling puts with a very tight leash on them or waiting for a buy the dip signal. And AA, I'll glad to give you the floor to sell against that and give me your thesis, because I think you're bearish on this one.
I am, yeah, and it goes back to some of the reasons I said, a little bit more of a macro view having to do with interest rates.
Yeah.
But also, I don't know how you look at, and I do use the market forecast, which you use here, but I also use a straight RSI a little bit more. How do you look at the momentum line here? So one of the things I see, one of the technical indicators I see that point to me a little bit in a more bearish direction is that the momentum line is achieving a series of lower highs.
Divergences. Yep, that I see that too. So you got a higher high in price and a lower high in the day trading time frame. Yeah. My counter argument is you've got a positive confirming divergence in the not a divergence, a convergence in the blue line. So that's why, because my time frame is green, and so blue underneath it, it's okay. But I could see, listen, that's why trading is a 50-50 proposition, right?
Yeah.
Who knows? Right now, I've got just full disclosure. What I'm trading on Qs in my real money account is actually a series of, I've got 2 strangles on, where the put strangle has been closer and the call strangle, a little side of the strangle, a little bit out of the money. And I've had to, adjust the put side recently. I just moved it up a little bit, and the call side is still around the 10-12 delta. So I am, in effect, neutrally bullish on the Qs, not taking a naked long shot.
Got it. So you have a few long delta.
Yep.
In the Qs. Got it. Okay.
Yep. And I might add a put if this starts to run. I might do what you do, but I do 2 puts to 1 call. and but all sold premium.
Got it.
And by the way, I know I might not be speaking your options language. I don't take many students, but I do take a few, and it's private one-on-one. You can just get in touch with me at the email address I put in the blog if you're interested in private lessons. I don't really know if I told you this, but my day job, I think they're going to cut the severed limb and get rid of the department that is just break even right now, and just throw us all away. So I think I'm going to be doing my trading. I'm going to have to ramp up the risk here and make some income to deal with some unemployment for a little while.
Got it. I mean, that's the world we're in right now, right?
It is. Luckily I know how to sell option premium, and so I'm going to be doing a lot of that over the next several months. And luckily for me, I probably can get away with eking out an existence selling options. Yeah. All right. So finally, we get to trading signals on a couple of the other ETFs that kind of fall. Notice we're following the strength of the market, and so XLK has another version of the stage 2 bullish progression signal. I won't get into that. And XITK is basically, I think, AA over the years. We've agreed that's just a mirror image of the XLK. We can't figure out what the difference is between that subsector. They have XNTK, which is innovative tech, which I understand that difference, but not this one.
Yeah, I can't articulate the difference either.
All right, so let's talk about TLT, and I think this is where your expertise can help us from a fundamental standpoint. Now, first, what we're getting here is a long-term moving average crossover, and that usually means price has to run quite a bit in order to pull that off, and just almost 100% of the time, we get a steep pullback in price after a golden cross like this, where the 10-week moving averages cross over the 40. And that's what's happened on TLT. We didn't get any sort of momentum confirmation or near-term line confirmation on that signal. We do have a bullish intermediate time frame supporting the long-term moving average cross, but notice that the long-term oscillator is a little bit bearish, meaning the path of least resistance is lower. I think probably entering this one, even if you ignored the tailwind score and thought that this is the flight to safety panic instrument, I just need more evidence that it's going to run beyond the few days leading up to the Fed meeting. But I don't see it here.
I agree with you 100%. I following the 10-year is what I do, and it's the low end of the range here around 3.4 ish. And I do think that it's just a result of the flight to safety, and eventually the banking situation will resolve and it'll be behind us, and that flight to safety will unwind.
Yep. And from a technical standpoint alone here, we've got this ascending trend line. We've got some serious resistance above here. This is a broken trend. This is a retest. And usually in this kind of case, especially with that bearish engulfing pattern from Friday, I think that's what that is. I can't tell. But I would say bouncing lower and higher interest rates is more likely here.
Yeah, I mean, regardless, I think maybe you'll agree with me here. Regardless of what the Fed actually does this week, they'll do their best to talk up the long end of the curve, right? Because that's what they need to have happen. Whether they do an action to provoke that or not, they'll do their best to talk it up.
You've probably looked at the 2-year Treasury note against the 10-year note. How bad is that yield inversion right now?
I haven't looked at it in a couple days, but I will say that it was maybe a week ago. Yields were inverted the worst that they have been since the early 80s, right? I think that, that was pretty widespread, reported pretty widespread.
Right. Yep.
Yeah.
Well, and explain what that means. That's usually, I don't think there's ever been a time where something like that hasn't predicted a pretty serious recession.
Not in the last several decades.
Yeah.
Right.
So there's just a lot going on in the market. It feels like the world could blow up into an expanded war at any minute. There's all sorts of shortages and higher prices, and the Fed doing everything they can to knock us into the unemployment line. So it feels like this is not going to be a trending market. We're going to be very tactical with our stuff.
Yeah.
And that means for premium cheat sheet subscribers, I think we're tightening up our time frames, and we're focusing on the 21-day moving average at best, with a 1 ATR stop below it. In your inbox today is a list of the most liquid ETFs, So these are the ones that are going to have options with lower bid-ask spreads and easier to. The other thing I wanted to talk about is if we do have a market shock, why it's so important to not only position size for your trade loss, but also position size so that you don't have too much of your money in any one trade because of liquidity issues. If we have something weird happens that when trading curbs kick in and, we're not able to get out of our longs, because stop losses are not that useful when markets are illiquid.
Right.
They're essentially market orders at below a certain price.
And a fast market move could just blow right past it.
Yep.
Yeah.
So couple of risk management reminders. If you are going to take a shot on the bullish side, be concerned not only with trade loss, but also with portfolio heat. My rules for these kinds of markets are to cut my risk in half. So if I'm just going to make up a number, $100,000 portfolio, if more typically I would I would buy enough shares so that once I set up my entry and my stop loss, I'd lose no more than $1,000 based on the number of shares I take, or 1% of my net liquidating value. Well, in a market like this, I cut that in half. So it would be $500 on any one trade. But the second rule that I put in place is where normally I would allow a position to be as much as 10% of my account, meaning, you buy some Tesla, you buy 3 shares of Tesla, probably costs $10,000 at this point, or maybe not now. But 10% used to be the position size max in a bull market. But in this kind of market, I cut that in half. So it's $5,000 allocated per $100,000 account, and it's $500 trade loss. So that really helps with the liquidity issue. If you got screwed and couldn't get out of an ETF because there is just a big line and not enough market specialists to accommodate you, you could suffer quite a big drawdown. And that cutting your position size and your trade risk in half will really help you survive. Just to give you an idea, if you were to have 10 trades on of $5,000 max and no more than $500 loss per trade, and let's just assume stop losses worked, then the market just crashed on you, well, you'd only be looking at a 5% drawdown on your account, right? It would be 10 $5,000 positions, or $50,000 worth of stock at 10 $5,000 positions, which each one only could lose $500 a shot. And so that's 10 times 500, or a portfolio heat of $5,000. You can recover from a 5% portfolio loss. 10%, 20%, 30%, that can take years, right, Double?
Yeah, easily take years.
So I think, the rest of this is some trade signals, and then I'll point out some premium cheat sheets. This is the last thing that we'll cover. There is one bullish trade that I think is interesting, and it is DRD. For premium subscribers, I walked you through it, suggesting not a outright naked stock purchase, but rather a sold put option, because the price of DRD has run. But this takes advantage of gold. Gave you a few fundamental reasons why DRD makes some sense right now. The biggest reason is this is one of those miners that doesn't hedge their pricing. So if gold goes higher, these guys haven't locked in at low prices. And so they could make listen, if gold wasn't about to move, which I think it might be, I'd be very nervous about this company because of that unhedged pricing. But they've also gotten their costs under control, and it looks like their margins are going to be decent, according to some analyst reports that I read. And from a cheat sheet standpoint, a 78-ish tailwind score with everything in agreement except long-term market forecast, which is definitely bearish. So here's the deal. That doesn't mean you can't have a bull run, but it's more likely going to last in the 1 month neighborhood and not the 3 month neighborhood, whenever you kind of have that long-term pressure against it. But the other thing I'd say is that while the market is down, gold generally in these type of conditions is a non-correlated asset. And so there's a better chance that the gold and gold miners survive. But again, I'm still about 21-day moving averages, not about 40-day moving averages is my line in the sand. But DRD is in your cheat sheets with an explanation. And finally, again, premium subscribers ran a list of stocks that have really high money flow and bullish fundamentals. You'll notice that the tailwind scores are generally better. I would say that if the Fed gives us good news on Wednesday and doesn't decide to tighten anymore, there's an opportunity here, and these are going to be some of the best names. It's in your inbox. No trading signals, but a good place to get very bullish fundamentals and a good technical setup. And then of course some deeper explanation as to which trades could make sense. So that's it for us. I think that's a lot of material. Your eyes glazing over in the back of your head?
No, that's a lot of great material.
Hopefully you can join us again next week, and we'll, you and I can get in sync about what's going to be in, kind of on the agenda, so you're not playing catch up like you were this week.
Sounds great.
All right, Double. Until next week, and thank you, everybody. Remember, go to stockcheatsheets.substack.com to pick up your free subscription. There's no credit card. There's no sales guy that's going to harass you. You decide to elevate yourself to the paid. That's for you to decide to do. Price is $5 a month or $50 a year. And love to have you either as an all-access subscriber or a premium subscriber. We'll talk to you again next week.
Thanks for watching. Become an all-access member at stockcheatsheets.substack.com to get free trade entry signals delivered to your inbox.